Every time the Federal Reserve holds an FOMC meeting, the financial media asks the same question. Will the Fed raise interest rates? But professional investors are asking a completely different question. They're asking, what does the Fed want us to believe? That single difference separates amateur investors from professionals. Today, we're going inside the hidden game behind every FOMC meeting. Because what moves markets isn't the decision itself. It's the expectations the Federal Reserve creates. Let's begin with something most people never realize. The Federal Reserve doesn't simply manage interest rates. It manages expectations. Imagine you're driving down a highway. Suddenly, without warning, the road ends. Everyone crashes. Financial markets work the same way. If the Fed shocked investors every few months, the economy would become unstable. Markets hate surprises. Central banks know this. That's why almost everything the Fed does is designed to prepare investors before anything actually happens. The interest rate decision is often just the final step. The real work started weeks, or even months, earlier. That's why experienced investors rarely ask, will rates go up? Instead they ask, what has the Fed been preparing us for? Every speech, every interview, every economic projection, every sentence released by the Federal Reserve forms part of a larger conversation with the market. Think of it as psychological guidance rather than economic policy. Here's where things become interesting. Suppose the market believes there's a 95% chance of a rate cut. Everyone has already adjusted. Banks, hedge funds, pension funds, ETF managers, algorithms, they've all positioned themselves for that outcome. Then the Fed announces exactly what everyone expected. Rates are cut. Yet, stocks barely move. Sometimes they even fall. Why? Because the news was already priced in. Professional investors often say, the market buys the rumor and sells the news. Prices don't wait for events. They move ahead of events. This is one of the hardest concepts for new investors to understand. Markets don't trade today's reality. They trade tomorrow's probability. By the time you read the headline, Wall Street has usually been preparing for weeks. That's why reacting to breaking news is often too late. The market already moved, so if everyone already expects the decision, what actually matters? The answer is everything surrounding the decision. The statement, the economic projections, the dot plot, and finally, Jerome Powell's press conference. Ironically, the interest rate decision itself may be the least important part of the day. Let's talk about the statement. Most people read it once. Professional traders compare it line by line against the previous meeting. Did one adjective disappear? Did one sentence move to another paragraph? Was the word asterisk, persistent, asterisk replaced with asterisk, moderating? These tiny edits aren't accidents. Every word is negotiated. Every sentence is intentional. Nothing appears by chance. In fact, large financial firms use software that compares every new statement against the previous one within seconds. The computer highlights every changed word. Before television commentators even finish reading the statement, algorithms have already found every edit. Some trades are executed before a human has finished the first paragraph. Then comes the dot plot. Many people misunderstand it. They think it's a forecast. It isn't. It's closer to a window into how policymakers are thinking today. Each dot represents one official's opinion. No names, no promises, just anonymous expectations. But together, those dots reveal something extremely valuable. The direction of the committee's thinking. Suppose the interest rate stays exactly the same. Most people assume nothing happened. But imagine the median dot shifts from expecting 3 rate cuts next year to only 1. The interest rate didn't change. Yet the future changed, and markets trade the future. Not today. Then Powell walks onto the stage. This is where markets become extremely nervous. Because unlike the written statement, live questions cannot be perfectly scripted. Journalists ask unexpected questions. Powell answers in real time. Sometimes he hesitates. Sometimes he repeats a phrase. Sometimes he avoids answering altogether. Every pause, every expression, every choice of words, is analyzed instantly. Professional investors aren't just listening to what Powell says. They're listening to what he avoids saying. This is why you'll often see markets reverse direction during the press conference. Stocks may surge immediately after the statement, only to fall 30 minutes later. Nothing changed, except the market's interpretation. Now let's connect this to Bitcoin. Many people still believe Bitcoin exists outside the traditional financial system. That was true years ago. It's much less true today. Institutional investors now own large amounts of Bitcoin through ETFs and other investment vehicles. When the expected path of interest rates changes, their entire portfolio changes. Not just stocks, not just bonds, everything, including Bitcoin. Bitcoin doesn't react because Powell mentioned Bitcoin. It reacts because global liquidity expectations change. And liquidity is one of the strongest forces driving risk assets. Here's another misconception. People think the Fed controls markets. In reality, the market constantly tries to predict the Fed, while the Fed constantly watches how the market reacts. It's a feedback loop. The Fed sends signals, markets interpret them, the Fed watches those interpretations, then adjusts its next message. It's less like giving orders, and more like a continuous negotiation. This is why professional investors spend so much time studying the Federal Reserve's communication. Not because they care about headlines, but because they're trying to answer one question before everyone else. How will everyone interpret today's message tomorrow? That's where the real opportunity exists. So the next time someone asks, did the Fed raise rates? Remember, that's only the surface. The real story isn't the decision. It's the expectations behind the decision. Because in modern financial markets, money doesn't move when events happen. Money moves when expectations change. And that's the game the Federal Reserve has been playing for decades.